Markets don't usually collapse the way people expect. There is no alarm. No single moment where everything suddenly breaks. What happens first is quieter and far more dangerous. Before prices fall, before volatility explodes, markets stop functioning the way they should. They freeze. And by the time most people realize that has happened, the outcome is already locked in. Most market participants are trained to watch prices, charts, candles, headlines, percentages. If prices are stable, the system is assumed to be healthy. But price stability is not the same thing as market stability. Price is a surface signal. What matters first is whether the system underneath can still move, absorb stress, and transfer risk. When that mechanism fails, price simply reacts late. This is why market crashes often feel confusing in hindsight. People look back and ask how everything seemed fine just days before. Why there were no obvious warnings. Why liquidity disappeared all at once. The answer is that the warning signs were there, but they didn't show up in price. They showed up in funding, liquidity, and market plumbing. Price is always a lagging indicator. It does not lead stress. It reflects it after the system has already absorbed more pressure than it can handle. By the time prices start moving aggressively, decisions have already been forced. Positions have already been unwound. Liquidity has already been pulled. Price is not the cause. It is the result. One of the biggest illusions in modern markets is the illusion of depth. Spreads look tight. Trades continue to print. Screens appear active. But none of that guarantees that the market can absorb size. Real liquidity is not about whether trades happen. It is about whether large positions can move without breaking the structure underneath. High-frequency systems can refresh quotes rapidly, creating the appearance of stability. Orders appear and disappear in milliseconds. As long as flows are small, the system holds together. But that apparent depth can vanish instantly when pressure increases. What looks like a functioning market is often just a fragile surface. This is why price can remain calm, even as risk builds underneath. Liquidity providers continue operating as long as conditions stay within narrow limits. But those limits are tighter than most people realize. Once they are breached, behavior changes abruptly. And when that happens, the transition is not gradual. It is mechanical. The first real signal of stress almost never appears in price. It appears in funding. Funding is the cost of carrying positions. It is the price of time in the financial system. When funding becomes more expensive, risk does not disappear. It concentrates. Funding stress does not announce itself loudly. There are no dramatic headlines. No obvious panic. Instead, the cost of maintaining leverage slowly rises. Margins increase. Haircuts widen. Financing terms tighten. Each change appears manageable on its own. Together, they begin to reshape behavior. When funding costs rise, leverage stops being neutral. Positions that looked stable become fragile. Trades that worked perfectly under cheap financing start to fail under tighter conditions. The problem is not the trade itself. It is the cost of holding it. This is why funding stress is so dangerous. It operates mechanically. It does not depend on sentiment. It does not require fear. It simply changes the math. As funding tightens, participants are forced to make choices. Either provide more capital or reduce exposure. For highly leveraged players, providing more capital is often impossible. So exposure is reduced. Positions are trimmed, then closed, then unwound entirely. This is where the compression phase begins. And this phase follows a pattern that repeats across cycles. First, volatility increases slightly, even if price remains stable. This triggers risk models. Margins are adjusted. Collateral requirements rise. Not dramatically, but enough to matter. Second, leveraged participants begin to feel pressure. They are not panicking. They are responding to constraints. Funding is more expensive. Carrying positions requires more capital. Risk tolerance shrinks. Third, forced behavior emerges. Assets are sold, not because their outlook has changed, but because balance sheets demand it. This selling is not emotional. It is procedural. Fourth, arbitrage relationships weaken. Strategies that rely on small, stable spreads break down. Price relationships that normally self-correct stop doing so. The mechanisms that usually stabilize markets begin to fail. Fifth, liquidity providers step back. Not because they are afraid, but because risk has become asymmetric. Inventory becomes harder to manage. Balance sheet usage increases. Returns no longer justify exposure. At this point, liquidity does not disappear because everyone panics. It disappears because the system no longer rewards providing it. This is the moment most people miss. There is still trading. Prices may still look orderly, but the system is no longer resilient. It has become brittle. When liquidity providers withdraw, the market loses its shock absorbers. Small imbalances create outsized effects. Order books thin out. Depth collapses. The market can still move, but only in jumps. This is why liquidity seems to vanish everywhere at once. It is not a coincidence. It is structural. Dealers and market makers operate within constraints. They manage inventory, capital usage, and risk limits. In calm conditions, those constraints are invisible. Under stress, they become binding. When selling pressure increases, dealers are asked to absorb more inventory. Their balance sheets expand. Risk exposure rises. At some point, they reach capacity. When that happens, they stop providing liquidity. Not gradually, immediately. At the same time, investors facing funding pressure try to raise cash. They sell what they can, not what they want. Even safe assets are sold. Even liquid instruments are liquidated. This is not a flight to safety. It is a flight to cash. This behavior creates a feedback loop. Selling reduces liquidity. Reduced liquidity increases volatility. Higher volatility tightens funding further. Funding pressure forces more selling. The system feeds on itself. This is the freeze. Not a crash, a stall. Markets appear active, but movement becomes constrained. Prices gap instead of adjusting smoothly. Execution becomes unpredictable. The ability to exit positions disappears before prices reflect the true level of stress. This is why panic comes late. Emotion follows mechanics. By the time fear shows up, the system has already made its decision. Most market participants experience this phase as confusion. They cannot reconcile calm prices with failed executions. They cannot understand why trades that always worked suddenly do not. They assume something external must have changed. But nothing external is required. The system simply reached its limits. This is the fundamental misunderstanding behind most market narratives. Crashes are treated as causes. They are not. They are consequences. The real event is the freeze. The moment liquidity stops flowing freely. The moment leverage becomes toxic. The moment funding dictates behavior instead of opportunity. Once that moment passes, outcomes are no longer optional. They are enforced. Price reacts last, always, by the time price reacts, the system already froze.